Hey folks, welcome you all to a new video. This is CA Ganesh Bharadwaj. So let's get started with a brand new chapter called Marginal Costing. Now, this chapter Marginal Costing helps achieve the objective of decision making. So this chapter Marginal Costing helps achieve what? The objective of decision making. And we saw in the basic concepts chapter itself that whenever the objective is decision making, then cost should be looked at from the perspective of what? From the perspective of variable cost and fixed cost. Correct? Yes. So cost should be looked at from the perspective of variable cost and fixed cost. Now, what do you mean by a variable cost and fixed cost? Basically, we've seen this in basic concepts chapter, but let me just brush up the concept for you. So we know that variable cost increases proportionately with the volume, whereas fixed cost remains constant. Or in other words, variable cost remains constant on a per unit level, fixed cost remains constant on a total level. And this is why we know that variable cost makes sense to be represented on a per unit level and fixed cost makes sense to be represented in total level. Yes, we have seen this before. Now with this backdrop, let us get into the basic concepts involved in marginal costing, right? Fine. Now we will understand the basic concepts involved in marginal costing by taking one example, right? So let me just note down that example for you. Example. So we will learn the basic concepts of marginal costing through this example. Let's say selling price is equal to rupees 10, then variable cost per unit is equal to rupees 6, then fixed cost, I'm just writing a short form FC, fixed cost is equal to rupees 10,000, sales volume is equal to, let us say, 6,000 units. Now what is required? Number one, marginal costing income statement. Marginal costing income statement. Then number two, profit volume ratio. Profit volume ratio, popularly known as PVR. Okay, profit volume ratio. I will explain every single thing, don't worry about it. Next, third, break even point. Break even point. Within bracket, let's call it as BEP. Right? Then fourth, margin of safety. Margin of safety. Within bracket MOS. So we will be using the short forms henceforth. Just know the full form of that. Right? And 5, profit. Number 5, profit. So now we are going to understand the basic concepts of marginal costing using this particular example. Now don't take this just as an example to solve it. No, through this example, we will take this example as a tool to understand the basic concepts of marginal costing. Let us spend more time here on the basic concepts so that throughout this chapter, it's going to be very, very easy, right? Students generally make a common mistake by mugging up the formulas in marginal costing. Trust me, there should not even be a single formula in this chapter that needs to be mugged up. You shouldn't mug up even a single formula. Every single formula, you should come up with the logic behind it so that automatically you need not take the pain in remembering the formula. You can automatically know the reason why a particular formula has come, right? So this is the example. Selling price, obviously selling price is per unit only, always. Selling price per unit is 10. Variable cost per unit is 6. Fixed cost is 10,000. Sales volume is 6,000. And we know that variable cost is, an example for variable cost is material cost or labor cost. So we know that only if you produce one additional unit, you will be incurring this 6 rupees extra. Else you will not be incurring this cost, correct? Whereas fixed cost 10,000, whether you produce 1 unit or not, whether you produce 1 unit or 10,000 unit or 1 lakh unit, whatever it is, fixed cost remains constant on a total level. Yes, an example for fixed cost may be factory rent, correct? Yes. So you know this particular fixed cost, variable cost and all. So now let's move into the basics of marginal costing. So what is required? First, marginal costing income statement, then calculation of profit volume ratio, then break even point, margin of safety and profit. Let us slowly enter into one by one and let us understand the concepts so that the entire foundation of marginal costing will be built, based on which we can actually build up the further complicated areas. Clear with this? Yes. Now first let me get into the most important aspect of this chapter, which is marginal costing income statement. So what have they asked? Marginal costing income statement. So marginal costing income statement. Okay, right. Fine. Now, marginal costing income statement will look like this. Sales minus variable cost is equal to contribution from here minus fixed cost gives you profit. Now, what is this, sir? What is this? Sales minus variable cost is equal to contribution minus fixed cost is equal to profit. Now this is the marginal costing income statement. I will explain the logic for this statement and how it helps in our decision making. All of that we will be learning in a few minutes from now. First, let us just fill in the blanks. Let us just fill up this particular statement and then I will explain. Now first, tell me, what is the selling price per unit? We know the selling price per unit is 10 and the number of units sold is 6,000 units, correct or not? Yes. So let me just take a blue ink and fill up this particular figure. So we know that how many units? 6,000 units is the output volume, and every unit generates how much rupees of selling price? 10 rupees. So now what is going to be your total sales value? It is going to be in rupees. It is going to be how much? It is going to be 60,000. Correct? It is going to be 60,000. Then what is the variable cost? How many units are we selling? 6,000 units. Yes. And every unit I'm incurring a variable cost of how much? Every unit I'm incurring a variable cost of 6 rupees. Correct? So I'm incurring a variable cost of 6 rupees. So what is the total variable cost? The total variable cost is how much? 36,000. 36,000. Right. Now 60,000 minus 36,000. So how much is this? 24,000, right? 24,000. 24,000. This is called as what? Contribution. Now wait. Let us just halt here. Let us halt here and let us understand what this is. Now we know that every unit I sell, it generates a variable revenue. That is what? An incremental revenue. If I sell 1 unit, I will get 10 rupees extra. That is 10 rupees as my revenue. Correct? Yes. Now, for me to produce and sell that 1 extra unit, I incur how much variable cost? I incur 6 rupees of variable cost. So, 10 rupees, can I say, is a variable revenue? Variable revenue? Yes, just for our discussion sake, can I call it as variable revenue? It is variable only, no? It varies with the output, correct? Only if I produce and sell one extra unit, I will get one more 10 rupees, correct? And only if I produce and sell that one extra unit, I will incur this extra 6 rupees, correct? And 10 minus 6, or in other words, can I say, if I produce and sell one extra unit, every unit I actually produce and sell, it generates a variable profit of 4 rupees. Can I say like this? Yes. So if I produce and sell one unit, I get a revenue, a variable revenue of 10 rupees. I incur a variable cost of 6 rupees. So I make a variable profit of 4 rupees every time I produce and sell one unit. Yes. Now, is this 4 rupees per unit a total? Is my final profit? No. Why? Because fixed cost is yet to be adjusted. Correct or not? Or in other words, every time I sell one unit, it generates a variable profit of 4 rupees, and that variable profit is only called as contribution. Are you clear with this? Or in other words, here I can make this calculation. How many units are we selling? 6,000 units. Every time I sell one unit, it actually generates how much amount of variable profit? 4 rupees of variable profit. That variable profit is called as what? Contribution. So the contribution per unit is how much? 4 rupees. 6,000 into 4, 24,000 rupees is actually going to be my total contribution. Correct? Is this my final profit? No, it is only a variable profit. Why? Fixed cost is yet to be adjusted. So now how much is our fixed cost? How much is our fixed cost? Our fixed cost is 10,000 rupees. So from this 24,000, I will reduce 10,000 rupees, and the final profit that we get is how much? 14,000 rupees. Are you clear with this? Right? So every time I sell a particular unit, it generates a variable revenue of 10 rupees. For me to generate that revenue of 10 rupees, I incur a variable cost of 6 rupees. So technically, every time I sell a unit, I actually generate a variable profit of 4 rupees. Yes. Now, is this the final profit? No. Because I have not yet adjusted my fixed cost. So now my total contribution is 6,000 units that I have sold into 4, which is 24,000. From that, I actually reduce my fixed cost of 10,000 and I get a final profit of how much? 14,000 rupees. Now, this 24,000 is nothing but what? This is nothing but, I just told you, this is nothing but variable profit. Correct or not? I just told you this is nothing but variable profit. Yes. Then, sir, why are they giving it a name called as contribution? Do you have this doubt? Why are they calling this as contribution? They can rather call this as variable profit. Yes, there is a logic why it has a name called contribution. Now, you just see here, this particular 24,000 rupees is there. Correct? This is our variable profit. This is not the final profit. This is the variable profit. So every unit the company has sold, the company makes how much? A variable profit of 4 rupees. So till now they have accumulated a total variable profit of how much? 24,000 rupees. Now using this 24,000 rupees, what they do is, first they try to recover what? Their fixed cost. So out of this 24,000 rupees, first they recover their fixed cost, and over and above the recovery of fixed cost, whatever balance that they have with them is called as their profit. Yes or no? Or in other words, this variable profit of 24,000 rupees goes on to contribute first towards recovery of fixed cost, then towards earning our profit. Or in other words, this variable profit contributes towards recovery of fixed cost and profit, and hence the word contribution. Since the variable profit contributes towards recovery of fixed cost and profit, it is called as contribution. Are you clear with this? In simple terms, this contribution is nothing but the variable profit that you can calculate on a per unit level. It is nothing but selling price minus variable cost. If you want to calculate it on a unit level, if you want to calculate it on a total level, it is sales minus variable cost gives you contribution. Are you clear with this? Yes. And it is called as contribution because it contributes towards two things. First, towards recovery of fixed cost, then towards earnings the profit. So out of the 24,000 rupees I have made, that is not my final profit. First, I adjust my fixed cost of 10,000 rupees, and the balance that I have is actually my profit. Are you clear with this? So this is the marginal costing income statement. This is very, very important. So once again, you just tell me, what is the marginal costing income statement? Sales minus variable cost gives you contribution. Contribution from that minus fixed cost gives you profit. Are you clear with this? This is the first basic fundamental of marginal costing. This income statement of marginal costing is a must. So for all the sums that we do, we need to know this particular income statement. Very simple. Sales minus variable cost gives you contribution. Contribution minus fixed cost gives you profit. Are you clear with this? As simple as that. Fine. So now we have prepared what? The first part of this question that we have given the example is over. Marginal costing income statement. We saw all the components and we also learned why this is called as contribution. Yes, done. Now let's move to the second part of the question, which is profit volume ratio. Profit volume ratio. Profit volume ratio, popularly known as PVR. Popularly known as PV ratio or PVR. Clear? Now, what do you mean by profit volume ratio? Right. Let me just continue with this example. Now, let us take the first half of our marginal costing income statement. So, how does our marginal costing income statement start? Sales minus variable cost gives you contribution. Correct? Yes. Sales minus variable cost gives you contribution. Yes. Now, on a per unit level, P.U stands for what? Per unit level. What is the sales? That is, what is the selling price? 10 rupees. What is the variable cost? 6 rupees. Yes, 6 rupees. So, what is the contribution per unit? It is going to be 4 rupees. Yes or no? Yes. Now, suppose for the output data given, that is for 6,000 units, what is the sales value that is given? Yes, we know it is nothing but 60,000 rupees. Yes. What is the variable cost? It is going to be 36,000 rupees. 36,000 is nothing but 6 into 6,000. Yes. So, what is the total contribution? 4 into 6,000. That is 24,000 rupees. Yes or no? This is what we saw till now. Yes, so we know that all these components, sales, variable cost and contribution, all these components can be represented on a per unit level, or they can be represented for any given volume level. Yes, so sales, if you represent it on a per unit level, it is called a selling price. If you represented it total, you call it as sales. Correct? Variable cost per unit or variable cost, that's all in total. Similarly, contribution, you can say this is contribution per unit, or you can just say contribution if it is mentioned for a given output level. Are you clear with this? I'm just introducing you to certain terminologies that we generally use. Now you tell me now what we have done here is contribution we have found out or represented it on a per unit level or on a total level. Now can I say if I want to establish my contribution as a percentage of sale, if I want to establish my contribution as a percentage of sale, you tell me how much will it be? That is, if my sales is 100, yes, I'm just saying if my sales is 100, now how much is my contribution? So contribution, if I want to represent it as a percentage of sale, so tell me how much is it going to be? Can I say this is nothing but 4 divided by 10 into 100, or in other words, my contribution, if it is expressed as a percentage of sale, can I say this is nothing but 40%? Yes or no? Yes or no? Yes. So if in this case, every time I sell one unit, It generates how much? 10 rupees of sales, selling price, correct? And I know that it generates a contribution of 4 rupees. If I want to establish my contribution as a percentage of sale, can I say generally my contribution is 40% of selling price, or my contribution is 40% of sales value, correct or not? So if you establish the contribution as a percentage of sales, that is actually called as profit volume ratio. So in this case, if you see, this 40% is called as PV ratio, or in other words, PV ratio is nothing but contribution upon sales into 100. Yes, contribution upon sales into 100, right? You can do this calculation on a per unit level, or you can do this calculation for any output level. It will be the same. 4 divided by 10 is 40%. 24,000 divided by 60,000, you calculate and see. 24,000 divided by 60,000, that will also be 40%. Are you clear with this? So PVR means what? Profit volume ratio. When the profit is expressed as a percentage of sale. What profit? Variable profit. Are you clear with this? So when the variable profit is established as a percentage of sale, that ratio, the PV ratio, that is the profit for the volume. Here profit stands for contribution, volume stands for sales. So here when you are establishing the contribution as a percentage of sale, that is actually called as PV ratio. Now, sir, why should I calculate PV ratio? Why should I calculate PV ratio? Yes, you might be having this doubt. Yes. Now remember, whenever we have sales, sales can be represented either on unit level. It can be represented in units, or it can be represented in value. Let us say, I can say that my sales is 6,000 units. I can say my sales is 6,000 units, correct? Or I can also say that my sales is 60,000 rupees, correct or not? Yes, so I can express sales in terms of volume, that is in terms of units, or in terms of value, that is in terms of amount, correct? When I express sales in terms of units, yes, if I multiply that units with the contribution per unit, I will get the total contribution, correct? 6,000 units into 4, I know that 24,000 rupees is my contribution, correct? Suppose someone is saying, I am going to make sales worth 1 lakh rupees. So you tell me how much is going to be my contribution. So they are not expressing sales in units here. They are directly saying sales in terms of value. So I'm going to make sales worth rupees 1 lakh. How much is going to be my contribution? You can use this concept of PV ratio. PV ratio 40% means what? Every time you make sale worth 100 rupees, your contribution is going to be 40 rupees, correct? So basically your contribution is nothing but 40% of your sales value. Now in this case, if someone is saying I'm going to make sales worth 1 lakh rupees, immediately 1 lakh into 40%, your contribution is going to be how much? 40,000 rupees. So if sales is mentioned in terms of value, you can multiply that with profit volume ratio to arrive at what? At your contribution. If sales is mentioned in unit, you can multiply the contribution per unit and arrive at the contribution value. Are you clear with this? Yes. Suppose someone is saying, I'm going to make sales worth 1 lakh rupees, correct? So how much is the contribution? 1 lakh into PV ratio, profit volume ratio, 40%, which is going to be how much? It is going to be 40,000 rupees. Instead of 1 lakh rupees, they are saying, no, I'm going to make sales worth 10,000 rupees. It is also the same, but they are expressing it in units. They are saying, I'm going to make sales of 10,000 units. Immediately you can say 10,000 units, every unit generates a contribution of 4 rupees. 10,000 into 4, 40,000. So if sales is expressed in units, you can multiply that with contribution per unit and arrive at what? And you can arrive at your contribution. If your sales is actually mentioned in value, you can multiply that with PV ratio to arrive at the contribution. Are you clear with this? So that is why PV ratio is important. In this case, if you see 6,000 units into 4 is 24,000, correct? Or you can also say, if they have given only sales in value, you can say 60,000 into 40 percentage, 20,000, 24,000. This way also you can arrive. Are you clear with this? So when something is given in value, you can use your PV ratio to arrive at your contribution. Are you clear with this? Yes. So what we have learned here, profit volume ratio is nothing but contribution divided by sales into 100. Are you clear with this? And the previous step we have learned the marginal costing income statement, and we also learned the reason why this is called as contribution, because it is called as the contribution because it contributes first towards a recovery of fixed costs, then it goes on, whatever balance I have is my profit. Are you clear with this? Have this crystal clear understanding, because based on this only the subject is going to be built, right? So now we have also seen profit volume ratio. Now let's move to the third concept. Which is called as break even point. Break even point. Now, what do you mean by a break even point? What do you mean by a break even point? The short form for break even point is BEP. Break even point is the level of sales at which profit is zero. It is the level of sales at which the profit is zero. That is, break even point, first you understand, break even point is not some out of the blue concept. No, say break even point is a point of sale. It is some point of sale at which my overall profit is zero, or in other words, I neither make a profit nor do I make a loss. Are you clear with this? So what do you mean by a break even point? Break even point is a point of sale. It is a level of sales only. It is also sales. It is a level of sales at which I neither make a profit nor do I make a loss. Are you clear with this? Yes. Now, sir, at what point of sale do I make no profit, no loss? That is only called as break even point. Now, to understand this, let us again quickly, in a rough manner, let us drop the marginal costing income statement. This will enhance your level of understanding. Now, what is the marginal costing income statement? Please, come on, let's do it together. It is sales minus variable cost gives you contribution minus fixed costs gives you profit. Yes, right. Now, what do you mean by a break-even point? Break-even point is that level of sale where I neither make a profit nor do I make a loss. Or in other words, in this case, my profit should be equal to zero. Correct? My profit should be equal to zero. So when will my profit be equal to zero? When my sales is equal to total cost. Correct? When my sales is equal to total cost. Or in other words, can I say this scenario, no profit, no loss scenario happens when my contribution, when I earn a contribution that exactly recovers only my fixed cost. So can I say that break even point, this scenario happens, the no profit, no loss scenario happens when I earn contribution that is exactly equal to my fixed cost. That is exactly equal to my fixed cost. Yes or no? Now, if I earn contribution more than my fixed cost, then what happens? Beyond the fixed cost, I have some money that goes to my profit. No. Suppose if I earn contribution that is not even sufficient to recover my fixed cost, then it will result in a loss scenario. That should also not happen. Or in other words, at the break-even point, can I say my contribution is just sufficient to recover my fixed cost? Or in other words, my contribution is equal to fixed cost? Yes or no? Yes. So can we say that at break-even point, can we say at break-even point, contribution is equal to fixed cost? Yes. contribution equal to fixed cost. Now let us say in our example, how much is the fixed cost in our example? In our example, the fixed cost was how much? 10,000 rupees. Yes, we can even refer this particular income statement. The fixed cost was 10,000 rupees, correct? So now what we are saying, our contribution should be exactly how much? 10,000 rupees. I am just taking our example, right? So we should earn a contribution that should exactly be equal to 10,000 rupees. Yes. So now we should sell how many number of units? So we should sell how many number of units to earn this 10,000 rupees is what we need to calculate, because basically break-even point is a point of sale. So how many units should be sold in order that my contribution is exactly equal to my fixed cost? In this case, how many units should be sold in order to generate a contribution of exactly 10,000 rupees? That's what we need to find out. And that many units is only called as break-even point. So now can I say we need to find the units. So units, or we can even take X. Okay. So if you want, you can even take this units as X, because that's what we need to find out. Units into every unit generates a contribution of how much? 4 rupees. So we know that we need to sell X number of units. Every units generate 4 rupees, correct or not? So X into 4 should be equal to 10,000, correct? So I'm trying to find out how many units should I sell in order to earn a contribution of exactly 10,000 rupees, correct? Only then my profit will be equal to 0. So at the break-even point, when will I be earning an exact profit of 0? When my contribution is equal to fixed cost. So can I say the required number of units is nothing but 10,000 divided by 4, or in other words, the required number of units is nothing but 2,500 units. So if I sell 2,500 units, now I will not make any profit. I will also not make any loss. My contribution is just enough to recover my fixed cost and end up in a 0 profit. Are you clear with this? So now what we have done here, so what we did was, we did 10,000 divided by 4, or can I say this 10,000 is nothing but fixed cost. Yes, and this 4 is nothing but contribution per unit. I am writing it as CPU. And this X number of units at which my profit is 0, this is only called as my break-even point. Yes or no? Can I say simply that break-even point, now break-even point in units, is nothing but fixed cost divided by contribution per unit. Yes or no? Can we just go and check the calculation here? How much was the break-even point we got? 2,500 units. Yes. So we saw that 2,500 units. At 2,500 units, you will make no profit, no loss. Can we just go and check it? So what is the sales at 2,500 units? 2,500 into 10, 25,000. Yes. So how much is the variable cost? 2,500 into 6. So 2,500 into 6, how much is that? 15,000. So how much is your contribution? Your contribution is going to be 10,000. Correct? 10,000. So selling price is 10, variable cost is 6, contribution is 4. So 2,500 into 4, 10,000. How much is the fixed cost? We saw that fixed cost is 10,000. So exactly your profit is 0. So we can say that if you sell 2,500 units, your contribution exactly recovers your fixed cost and you end up in a no profit or no loss scenario. So to calculate this is nothing but fixed cost divided by contribution per unit. Why? Because we know that I need to earn a contribution of 10,000 that is equal to my fixed cost, and I know that every unit generates a contribution of 4 rupees. So how many units should I be selling to recover a contribution of 10,000 rupees? So exactly fixed cost divided by contribution per unit. Are you clear with this? So break-even point is what? It is a point of sale where I make a no profit or no loss scenario. So if I want to express my break-even point in units, it is nothing but fixed cost divided by contribution per unit. Are you clear with this? Please don't mug up this formula. It's a very, very logical formula. This is the mistake what students do. They try to mug up all these formulas the day before the exam, put it in a sheet. No, it's a crime if you do this. I'm telling you, it's a crime if you do this. All these things are so logical. Take some extra time in learning the concept. You will thank yourself for a lifetime. It's my promise. I can tell you that. Fine. Now, break-even point is what? It is also a level of sale only. At sales level where your profit or loss is zero, correct? So if break-even point is also some point of sale, so it can also be expressed directly in values. Just now I told you sales can be expressed in units or in value. So break-even point, if you want to express your break-even point in value directly in rupees, how will you calculate that? Very simple, very simple. Fixed cost divided by PV ratio. Instead of contribution per unit, use profit volume ratio, PV ratio. I just told you, if things are given, if you want to find out certain things in units, use your contribution per unit. Wherever, if you want to find sales in value, you can use PV ratio. Or let me just put it this way. Now, we know that we need to generate a contribution of how much? 10,000 rupees, correct or not? 10,000 rupees, correct or not? Yes. Now we know that the PV ratio is how much? 40%, correct? So PV ratio is 40%. PV ratio means what? Contribution upon sales. The base is only sales. The sales is going to be 100%. Obviously, we know that. Yes. So now the required break-even point. So how much rupees worth of sale you should make in order to earn a contribution of 10,000 rupees? Very simple. In this case, my contribution should be equal to fixed cost. Yes. So if 10,000 has to be equal to 40%, how much should be 100%? Simple mathematics, or in other words, 10,000 divided by 40% you can do. 10,000 divided by 40%. So 10,000 divided by 40% means what? 10,000 divided by 40 into 100. That is the meaning, right? Or in other words, that is nothing but fixed cost upon PV ratio. In this case, if you just see, so fixed costs divided by PV ratio is nothing but how much? How much is the fixed cost? 10,000 rupees, correct? Because at break-even point, my contribution should recover exactly fixed cost. So this is the required contribution. If that is 40%, how much should be my required sale? That is what we need to find out. Required sale means what? Required sale to make my contribution equal to fixed cost, and that results in a zero profit or loss, correct? Yes. So, or in other words, if you want to find out the break-even point directly in rupees, you can just say fixed cost divided by PV ratio. This 10,000 divided by 0.4. How much you get? You directly get 25,000 rupees in value. Are you clear with this? So let me just do this here once again. So in this case, fixed cost is how much? 10,000 divided by contribution per unit 4. So how much is the break-even point in units? In units, it's going to be 2,500 units. Correct or not? Yes. In this case, no, sir. I want to calculate the break-even point directly in value. Very simple. You say 10,000 rupees is the required contribution. At the break-even point level, the required contribution is equal to fixed cost. So directly I will say fixed cost of 10,000 divided by PV ratio of 40%. So 10,000 divided by 0.4. 40% is nothing but 40 upon 100, which is 0.4. Correct. So how much is this? Rupees 25,000. Are you clear with this? So if you want, or in other words, you can also say break-even point, sir, I will find it in units. 2,500 units. So number of units into selling price. So 2,500 into 10, you will get 25,000. That way also you can do. But directly, if you want to calculate the break-even point means what? Break-even point is a point of sale. So wherever sales is coming, it can be represented on a units level, or it can be represented in value. If you want to calculate the break-even point in units, you can say the formula is fixed cost divided by CPU, contribution per unit. If you want to calculate the break-even points in value directly, it is fixed cost divided by PV ratio. Are you clear with this? See how logical it is. Students say this is one formula, this is another formula. They mug up all these things. Please don't do that. Okay. So what do you mean by a break-even point? It is the point where my contribution exactly recovers what? it exactly recovers my fixed cost. Clear with this? So only if I sell exactly 2,500 units, my contribution will be able to recover my fixed cost. Suppose I sell less than 2,500 rupees, that will be a loss scenario. Why? Because my contribution will not even be sufficient to recover my fixed cost. So obviously I cannot generate a profit. It is, my contribution is insufficient to recover even my fixed cost. It is a loss scenario. Suppose I sell over and above more than 2,500 units. So whatever units I sell over and above 2,500 units, that will go on to contribute towards my profit, because up to 2,500 units, my entire fixed cost is recovered. Now, over and above 2,500 units, whatever I produce and sell, it goes on only towards my profit. Are you clear with this? This is the analysis that we can make. See how beautiful this is, how beautiful all these concepts are, because this is the reason why we are saying marginal costing helps us in the objective of decision making. Now, let's go to the fourth concept. Let's go to the fourth concept. Concept number 4. What is it? Margin of safety. Margin of safety. MOS is the short form. Margin of safety. Now, let me just take this particular example. And explain this concept of margin of safety. Now, first, let me just write down what do you mean by margin of safety. Margin of safety is the sales above the break-even point. Margin of safety is the profit generating sales. Profit generating sales. Sir, what is this? I will explain right now. Right away, I will explain this concept of margin of safety. In our example, now you tell me, in our example, what is the total sales made by the company? What is the total sales made by the company? How many units were sold by the company totally? 6,000 units. Correct? 6,000 units. Yes, this is what they had given. The company has sold how much? 6,000 units. Correct or not? Carefully listen. Yes, 6,000 units. Now, we just found out the break-even point. Break-even point is how much? 2,500 units. We just found out that the break-even point, the BEP, break-even point is how much? It is 2,500 units. Correct? Yes, right. So now, what has happened? See, the first 2,500 units I produce, it just goes on towards recovery of my fixed cost, and exactly at 2,500 units if I sell, my contribution is exactly equal to my fixed cost. Or in other words, my contribution, I have built a contribution that has completely recovered my fixed cost. Correct or not? Now let us say I am selling 2,501th unit. The next unit I am producing and selling over and above the 2,500 unit, that extra 1 unit will generate a contribution of 4 rupees. Correct? And this extra 4 rupees will directly go on towards my profit generation. Why? Because the first 2,500 units, whatever contribution it has generated, it has already recovered entire fixed cost. Now, over and above, every unit I sell above my break-even point, whatever contribution that every unit that over and above my break-even point is actually generating, all these units whatever contribution that it generates goes on towards building my profit. Yes or no? Because the first 2,500 units, whatever contribution it has generated has gone towards recovery of fixed cost. Over and above the 2,500 units, whatever contribution I make is directly towards my profit building. Or in other words, whatever is the sale that is made over and above my break-even point is called as margin of safety. In this case, in our example, margin of safety is how much? My break-even point is 2,500, but my total sales, my actual sales is 6,000. So how many units over and above my break-even point am I selling? We are selling over and above our break-even point. We are selling 3,500 units. Yes or no? So whatever are the units that we are selling over and above our break-even point is called as margin of safety. Are you clear with this? Yes. Sir, why this word, sir, margin of safety? You might be having a doubt. Very simple. Just imagine you are the MD of a company, right? Currently you are selling 6,000 units. Next month, let us say there is you are seeing that it is a dull season for you. The market is going to fall. Immediately what you will see is, look, currently I have a safety cushion of 3,500 units. Or in other words, currently I'm operating at how much? 6,000 units. Max, my profit I can afford my sales volume to drop by 3,500 units, because if it drops beyond 3,500 units, then my actual sales level will be clocking at less than my break-even point. I will be making a loss scenario, correct? That is, if my actual sales is before the break-even point, less than the break-even point, this is a loss scenario. If my actual sales is at the break-even point, there is no profit or no loss, correct? If my actual sales is beyond my break-even point, that is where I am generating profit. So currently what I will see is how many units I am selling over and above my break-even point. 3,500 units. This is the extra cushion I have. So max, even if there is a downfall, even if there is a dull demand in the market, even if there is a dull season in the market, maximum my demand or my volume can drop only by 3,500 units for me to show some profit. If it drops beyond 3,500 units, then definitely my actual sales will be less than the break-even point and I will start making losses. For me to take this informed decision, we actually have something called as margin of safety. Are you clear with this? So we call it as margin of safety. So to what extent we are safe, we are knowing it, or in other words, whatever units that is sold over and above my break-even point is called as margin of safety. Are you clear with this? Yes. So I'm just quickly erasing this certain things that I have just mentioned here. 1 second. Yes. So whatever units that we are selling over and above our break-even point is called as margin of safety. Right. Fine. So can I say that margin of safety, how will you calculate? Very simple. The total sales minus the break-even point is going to be my margin of safety. Yes or no? It's that simple. Or let us also give a new perspective to this. Fine. So now what we can do is, let me just draw up the income statement, marginal costing income statement that we generally follow. Here, let's say sales minus variable cost gives us what? Get used to this. Contribution minus fixed cost gives us what? Profit. Yes. Gives us what? Profit, right? So let us fill in the figures. In our example, 6,000 units, right? So 6,000 units into 10. So the sales was how much? 60,000 rupees. 60,000 rupees. Yes. And then what was the variable cost? So the sales was 10 rupees per unit. Variable cost was 6 rupees per unit. Contribution was 4 rupees per unit. So multiply this respectively with the total units that we have got. Yes. So 10 into 6,000. So 6,000 rupees. Then variable cost is 6,000 units into 6 rupees, 36,000. Then what is the contribution? The contribution is 6,000 into 4, which is 24,000. Yes, fixed cost was given as 10,000. Yes, and the profit is how much? Profit is 14,000 rupees. Correct or not? Yes. Now let us look at this logically. Let us look at this logically. We have made a total contribution of how much? We have made a total contribution of 24,000 rupees. Correct or not? Yes. Total contribution of 24,000 rupees. How have we made this? So 6,000 rupees, 6,000 units have been sold. 6,000 units have been sold, correct? 6,000 units have been sold, and every unit into contribution per unit. Yes or no? Please just focus here, because this is a very important discussion. This is one area where students struggle and they mug up a lot of formulas. Please don't do that. Please don't fall into that trap. So now tell me, how have I generated this 24,000 rupees of contribution? Very simple. Totally you have sold how many units? 6,000 units. Perfect. Every unit was generating how much contribution? 4 rupees of contribution. 6,000 into 4, 24,000 rupees. Correct? Or let me put it this way. How was I able to generate this 24,000 rupees of contribution? Let's break it up. Let's break it up. First 2,500 units. First 2,500 units. What is the 2,500 units? Break-even point. The first 2,500 units generated that much amount of contribution that was sufficient towards recovery of my entire fixed cost. If you see here, 2,500 units, each unit generated how much contribution? 4 rupees. 2,500 into 4, I recovered my entire fixed cost. Correct? I am talking about the journey as to how I built up this 24,000 rupees of contribution. How I built up the 6,000 rupees, 6,000 units is made up of break-even point units and margin of safety units. Correct. So we are just breaking it up. How we built up, how we sold the 6,000 units. Sir, first 2,500 units I sold. The 2,500 units went on to recover my entire fixed cost. Yes, correct. So 2,500 units into contribution per unit. Yes. Then over and above, extra I sold 3,500 units. Each of these 3,500 units also generated contribution per unit of 4 rupees. Correct. So now first 2,500 units, whatever contribution it generated, with that entire fixed cost, I was able to recover 10,000 rupees. Yes. Over and above this, over and above my break-even point, whatever was the units sold, the margin of safety units, 3,500 units, each and every 3,500 units also generated 4 rupees of contribution. Yes, that directly went on to contribute towards my profit building. So can I say 3,500 into 4 is nothing but 14,000 rupees? Correct. Or in other words, the breakup of 24,000, we are giving it as nothing but 10,000 plus 14,000. Yes or no? First 10,000, how I got break-even point units, the break-even number of units into contribution per unit. Correct. Then how I got my profit? Margin of safety units into contribution per unit. Now you understand. This is why I said margin of safety is the profit generating sales. Are you clear with this? Are you clear with this? Are you clear with this? Very important. Very important. So now can you tell me what is the margin of safety formula? So now what is margin of safety? Margin of safety is also some sales only. Sales over and above my break-even point. So now margin of safety can also be expressed in units. Margin of safety can also be expressed in value. Correct or not? So first, let us see what is the formula for calculating margin of safety. Again, since margin of safety is also some sales only. Fine. So overall sales, we are breaking it up into break-even point and margin of safety. Are you clear with this? So total sales is nothing but break-even point plus margin of safety. Sales is built up like that. Are you clear with this? So first, margin of safety, I can express it in units or I can express it in value. How to express it in value? We will just see it now in a few minutes from now. In terms of units, there are two formulas. Let me explain the two formulas. The first formula is very simple. Total sales in units minus break-even point in units. Correct? Yes. Whatever is the total sales minus whatever is my break-even point, or in other words, the number of units I have sold over and above my break-even point is only called as margin of safety. Yes. Or there is another formula to calculate. What is that formula, sir? Suppose profit is given 14,000. Yes, we know the contribution per unit 4 rupees. We can say, can we say that profit 14,000. How I generated profit? This entire profit was generated only through the margin of safety units. Why? Because the break-even point units was generating contribution enough to recover only my fixed cost. So can I say this entire profit was actually generated through the contribution given by my margin of safety units? Or in other words, can I say if the profit is given, so can I say 14,000 rupees, 14,000 rupees, each unit generated how much of contribution? 4 rupees. So totally, how many units were responsible for creating this profit of 14,000? 14,000 divided by 4, 3,500 units, correct? That is only called as my margin of safety, correct or not? So the other formula for calculating the margin of safety is nothing but profit divided by contribution per unit. Are you clear with this? This is why I said break-even point is tied to fixed costs, correct? Margin of safety is tied to your profit, and your sales, the total sales, is tied to your contribution. Are you clear with this? So break-even point is what? Fixed cost divided by contribution per unit. Margin of safety is what? Profit divided by margin of safety, profit divided by contribution per unit. Are you clear with this? So this 14,000 rupees of profit was built through the margin of safety units, and every margin of safety unit generated a contribution of 4 rupees. So how many units were responsible for the profit creation? 14,000 divided by 4, which is 3,500 units. That is what is the margin of safety units. Are you clear with this? And the other way, if you want to calculate this in value, very simple. Again, two formulas, very simple. Total sales in value minus break-even point in value, right? Or you can use this formula, profit divided by what? Instead of contribution per unit, you can say profit divided by PV ratio. I will just prove it right now. So let's use these formulas and let's get the answer for this particular question. Total sales. So let's calculate margin of safety. Margin of safety is what? The first formula. Total sales in units minus break-even point in units. So total sales was how much? I have sold 6,000 units. And what is the break-even point in units? We just calculated. Break-even point in units is 2,500 units. So minus 2,500 units. So how much is that? This is going to be 3,500 units. Correct or not? Yes, this is going to be my margin of safety. Or the other formula is what? Profit divided by contribution per unit. I generated a total profit of how much? 14,000 rupees. Each and every margin of safety unit was only responsible for generating this profit. Yes, each and every margin of safety unit generated how much contribution? 4 rupees. So how many margin of safety units were actually responsible for generating a profit of 14,000? 14,000 divided by 4, that gives me how much? 3,500 units. Are you clear with this? An alternative way of finding this is total sales in value minus break-even point in value. Total sales in value is how much? 60,000 into 10. How much is that? 60,000 rupees. Correct? So my total sales was how much? 60,000 rupees minus break-even point in value is how much? 2,500 units into 10. Or we calculated in the previous step, it was how much? 25,000 rupees. Correct or not? 25,000 rupees. So 25,000 rupees you have. So now how much is going to be your margin of safety? 60,000 minus 25,000. It's going to be rupees 35,000. So in terms of value, the margin of safety is how much? 35,000 rupees. Or I can say 35,000 rupees worth of sales have been made over and above my break-even point. Are you clear with this? Or an alternative way of doing this is what? Profit divided by PV ratio. How much is the profit? 14,000 rupees. Correct? Yes. If this 14,000 is 40%, how much is the total value of sales that was responsible for generating the profit? Correct? Only the margin of safety sale was responsible for generating the profit, because the break-even sale was responsible for recovering my fixed cost. Margin of safety sales was only responsible for generating my profit. Correct? So if 14,000 is 40%, how much is 100%? Simple mathematics. Or in other words, profit divided by PV ratio. This is how much? Rupees 14,000 divided by 40%. Take your calculator. 14,000 divided by 0.4. How much is this going to be? Rupees 35,000. Are you clear with this? Rupees 35,000. Are you clear with this? This is an alternative way of calculating it. Alternative way of calculating. So always remember, I am once again rewriting this. Entire thing. We call this as marginal costing jodies. These are jodies. Break-even point is tied to fixed cost. Margin of safety is tied to profit, and total sales is tied to contribution. I am doing this once again. Have a crystal clear clarity in this case. So let me just do it once again for you. Let me just neatly do it. So here. So this is going to be what? Total sales. Yes, and then we have what? We have break-even point, and then we have margin of safety, right? Total sales is how much? Let me just take a green ink. 6,000 units, or in value it is going to be how much? 60,000 rupees, correct? Break-even point is how much? 2,500 units, or in value it is how much? 25,000 rupees, correct? And margin of safety is how much? 3,500 units, or in value it is how much? Rupees 35,000. Yes, this is what we have seen right now. And then you've got your marginal costing income statement. Sales minus variable cost gives you contribution, minus fixed cost gives you profit, right? So in our example, sales was how much? 60,000 rupees. So we know that the selling price is 10 per unit, variable cost is 6 per unit, contribution is 4 per unit. Yes, so with all this data, let us do it quickly. So 6,000 units is the total sales. For the total sales, so how much is the sales value? So 6,000 into 10, how much is the variable cost? It is 6,000 into 6, which is 36,000. So what is the contribution? 6,000 into 4, 24,000. The fixed cost was given as 10,000 rupees, and the profit is how much? 14,000 rupees. So now what we are doing here is, right now we are linking. So the total sales is tied to what? It is tied to contribution. Yes. Then break-even point is tied to what? Break-even point is tied to fixed cost. And margin of safety is tied to what? Margin of safety is tied to profit. And what is the tying factor? The tying factor is contribution per unit or PV ratio. Why? Or if you are representing these things in units, then use contribution per unit as a tying factor. If you are representing these things, BEP, MOS or total sales in value, then the tying factor can be called as PV ratio. Are you clear with this? This is the same for everything. The tying factor is what? It's contribution per unit or PV ratio. It is contribution per unit or PV ratio. Are you clear with this? So if someone has given you the break-even point and the contribution per unit, can you calculate the fixed cost? Yes. 2,500 into 4, you will get what? 2,500 into 4 fixed cost you will get. Or margin of safety they have given 3,500 units. Contribution per unit is given 4. You can directly calculate the profit. Why? Because profit is purely generated out of the margin of safety units. So 3,500 into 4 is going to be 14,000. Or they have given the total sales value and they have asked you to calculate the contribution. Yes, 6,000 into 4, you will get what? 24,000 rupees. Are you clear with this? This is called as marginal costing jodies. Fine. I'm naming it. As marginal costing jodies for our classroom discussion. A very, very important discussion. For some reasons, certain students mug this up. Please don't mug this up. It's very, very practical. You just need to take some extra time and understanding it conceptually. Every single sum, you will fall in love with it. You will start enjoying the beauty of this chapter. That's how it is. Fine. So I'm just writing it down here. Marginal costing jodies. Right? Marginal costing jodies. First jodi. First jodi. Sales is tied to what? Sales is tied to what? Contribution. Right? Total sales, I'm saying. Next. Break-even point is tied to what? Is tied to fixed cost. And then margin of safety is tied to what? Is tied to profit. Are you clear with this? Yes, are you clear with this? This is how you need to understand this particular basic concepts area. And of course, what is the tying factor? It can be contribution per unit or it can be PV ratio. It depends on how you want these figures. Sales is made up of break-even point plus margin of safety, correct? So since all these are sales, it can be represented in units or in value. If you want to express it in units, then the tying factor, use it as contribution per unit. If you want to express these in values, then take the tying factor as PV ratio. Are you clear with this? And I will also write down a very important thing. Sales is equal to break-even point plus margin of safety. Correct. Sales is made up of what? Sales is made up of break-even point plus margin of safety. Or in other words, any sales made over and above your margin of safety is called as, any sales made over and above your break-even point is only called as margin of safety. Correct or not? Yes. And remember one very important thing. As your sales volume increases, your break-even point and all will not change. Break-even point is a point. That's all. Fixed cost divided by contribution units. How many units should I sell to recover my fixed cost fully? Correct? Or in other words, resulting in a zero profit or zero loss. Correct or not? Yes. So break-even point is a point. Correct? Over and above break-even point, if I am selling more and more, my margin of safety will only change. Margin of safety is only a balancing figure. So always remember, as my volume increases, break-even point will not change. The extra cushion, the margin of safety will only increase. Clear? In this case, I have sold 6,000 units. Correct or not? We have sold 6,000 units. Yes. So now my break-even point is 2,500. So over and above my break-even point, how many units have I sold? 3,500. Suppose for example, I am selling 10,000 units. My actual sales is 10,000. Break-even point will still be 2,500 units. At 2,500 units, your profit, you will recover your entire fixed cost. Your contribution will be sufficient enough to recover your entire fixed cost. If you are selling 10,000 units now, which means your margin of safety now increases to 7,500. That is 10,000 minus 2,500. Now your extra cushion, your extra safety is more. So always remember, as the volume increases and all, your break-even point will not change. Margin of safety will only increase. Always remember, that's why break-even point, it is a point. That's all. It will not change unless and until there is a change in fixed cost. Fine, here we are not there. I will just tell you the assumptions that we are going to take in this chapter. But always remember, unless there is a change in the fixed cost and all, your break-even point will not at all change. So always remember, with your increase in output, extra margin of safety will only keep on increasing. Your break-even point will remain the same only. Are you clear with this? And this marginal costing jodies is a very, very important thing. So whatever they ask right now, you can actually do. So contribution divided by sales will give you PV ratio, correct? Or can I say fixed cost divided by break-even point in values? That will also give you PV ratio only. Yes, absolutely. Profit divided by margin of safety, that will also give you PV ratio only, because the tying factor is one and the same. Or in other words, let me put it this way, margin of safety in value into PV ratio is only profit. Correct or not? So break-even point in value into PV ratio is only fixed cost, or sales in value into PV ratio is only by total contribution. So can I say my sales is built up, my sales is made up of break-even point plus margin of safety, or in other words, my contribution is equal to fixed cost plus profit. Correct? So contribution is what? First it goes to recover your fixed cost. Whatever balance goes on towards generating profit. Correct or not? So contribution is equal to fixed cost plus profit only. Or you can even use simple mathematics. Contribution minus fixed cost is profit. Correct? If you take this fixed cost to the other side, profit plus fixed cost is going to be your contribution. You can just play around with this. You can just play around with the figures. You can generate some 20, 30 formulas if you want. provided you learn it conceptually. That's the power here. That's the power of conceptual learning it. Are you clear with this? And this is 100% a requirement for your exam. I am not doing anything over and above your requirement. It's a requirement for your exam. On the spot, you can write the formulas on your own. All you need is only this particular small statement: sales minus variable cost equal to contribution minus fixed cost equal to profit. If you are able to prepare the statement, automatically you can derive any formulas that you want. Of course, this vertical statement as well as this horizontal. What is this horizontal part? Break even point plus margin of safety is going to be your what? Your total sales. Sales is tied up to your contribution, break even point tied up to your fixed cost, and margin of safety is tied up to your profit. Correct? So up to the break even point, whatever contribution I generate, that is sufficient towards recovery of my fixed cost. Over and above my break even point, that is whatever margin of safety units, whatever they generate contribution, that is exactly my profit. Are you clear with this? As simple as that. As simple as that. Right? And finally, what have they asked in this particular question? What have they asked? I mean, in our example that I just took, fine. Okay, calculate the profit. It's already done. Anyways, let me just give you some formulas for calculating profit. If you want to put it in formulas, right? The fifth point is profit. Fifth point is profit. Fifth point is profit. So can I say formula number 1? Profit is equal to sales minus total cost. Sales minus total cost. Correct? Yes. Formula number 2. You tell me what could be another formula. Can I say profit is equal to contribution minus fixed cost. Correct? Contribution minus fixed cost is going to be my profit. Correct or not? That marginal costing income statement only. Yes. Right. 3. Can I say profit is equal to margin of safety in units into contribution per unit? Yes, my profit was purely generated out of the margin of safety units. Correct or not? Yes, can I say this? 3,500 units into 4 rupees per unit contribution, that only is 14,000 rupees. Yes, or can I say profit is equal to margin of safety in rupees, that is in value, into PV ratio. Correct or not? In this case, you just take in our example, you just take what is our margin of safety? 35,000. Yes, what is the PV ratio? Every time I make sales worth rupees 100, I generate a contribution of how much? 40 rupees. Or in other words, if I made a margin of safety, that extra sale was worth 35,000 rupees into 40%, how much was that? So 35,000 into 40% is what? 14,000 rupees. So the contribution generated out of my margin of safety, say margin of safety units, is only my profit. Correct or not? So if the margin of safety is represented in value, multiply it with PV ratio and arrive at your profit. It's that simple. Are you clear with this? Look at the power of conceptual learning. This is where slowly we started from the scratch and we have actually built the subject to this extent. Are you clear with this? It's that simple. You can now go and teach your friends also. If they are mugging up the formulas, you can clearly tell them, spend some time, take some 1 hour time, learn what it is conceptually. You thank yourself for a lifetime. Are you clear with this? Because if you go to the final level and all, if you mug up here, the final level will be very difficult. So you need to build your whatever you are learning, you need to know why you are learning it. That's the most important thing. And you need to build your foundation very strongly. Only then you can move ahead in the subject. Are you clear with this? Yes. So with this, see, right now for profit itself, I have given you 4 formulas. 4 formulas. Technically are these formulas. We derived everything. And should you mug up? Not even a single thing has to be mugged up. Are you clear with this? Yes. And the most important thing here is assumptions. Let me just state down the assumptions. The assumptions in marginal costing. Assumptions for this particular chapter, marginal costing. What are the assumptions? Number 1, selling price per unit is constant. Next, variable cost per unit is constant. And number 3, fixed costs in value, in total, is constant. So whatever we saw right now, all these formulas for break-even point, margin of safety, all of these things, PV ratio, whatever we saw, these are the 3 assumptions that you need to remember. Based on these 3 assumptions only, we are learning it. This is only there for your syllabus. What are the 3 assumptions? Selling price per unit is constant. Whether you want to sell 1000 units or you want to sell 1 lakh units, the selling price per unit is constant. Are you clear with this? Similarly, variable cost per unit is constant and fixed cost in total is constant. Are you clear with this? So these are the 3 underlying fundamental assumptions based on which we have seen whatever we have discussed in this particular video. Are you clear with this? So with this, we have covered all the basics of marginal costing. And if you want, you can also, I will also write down this one particular thing. This is important. This is important just to put it on record. That is just to put it here in our notes. Contribution contributes, let me branch it into 2, towards recovery of fixed costs, pulling an arrow up to the break-even point. Then contribution contributes towards profit, So this is where using margin of safety. Are you clear with this? So contribution contributes first towards recovery of fixed cost up to the break-even point, and it contributes towards recovery of profit through margin of safety. Are you clear with this? So your entire contribution is made up of what? Fixed cost plus profit, or in other words, your entire sales is made up of what? Your break-even point and margin of safety. Always remember this. So this vertical and horizontal statement, you always remember. Make the marginal costing jodies with you. Have it ready so that any kind of question that comes your way, you can easily tackle it. This is all about marginal costing. In all the sums that we will be doing, this is all about. Here and there, some small concepts we will be seeing, but for that, the foundation of marginal costing is all covered in this particular lecture. And please revise this thoroughly. You should have complete control over whatever I taught you in this particular video, because this acts as the foundation of our marginal costing. So whatever sums that we are going to see, sir, in this video we have not even seen one single sum. Trust me, more the time you spend on the concepts, lesser will be the time you spend in the questions. That is a time-tested strategy. This is the way to learn marginal costing. Clear? So on that note, I'm concluding this session. Please revise this entire session thoroughly. It's a very important session. Please revise this session thoroughly, and I will see you all in the next one. Thank you so much.